All right, so it's been quite a while since we did one of these because this is our very first regular. This is our very first regular society meeting. So this is how we usually start. We usually just start by just giving you an update about what's going on in the markets and just different aspects of the market. So if you ever if you ever have like a specific interest, so just like an M&A deal, or just a certain industry or sector that piqued your interest, and you're like, oh, I would like to talk about it, feel free to contact. I think it's Aisha. She organizes it, and you'll be put in, and then you get to I don't know, display your knowledge and share your financial knowledge with everyone else, and everyone will get to learn what you know. And so yeah. So there's been a lot that's been happening for the last couple of months, I would say. Last week, U.S. and China had a 90-day truce, which sent the rally around the markets. So in the last 2 weeks, the markets have recovered losses from the previous 2 to 3 months. So that was pretty nice. The Nasdaq has recorded their highest since February, and the tariffs went from like triple digits to single digits, which is what is the normal. But this is only for 90 days, so there is still a lot of uncertainty around this area. And with uncertainty comes a lot of movements from bond markets. So bonds are considered a lot safer than equities. So whenever there's a lot of uncertainty around equities, yields tend to go much lower, which means that a lot of people are buying bonds. They're going for the safe option, and U.S. Treasury bonds are the safest options in their default standard for safety. They're the risk-free rate that is used around the world, and they used to be considered the best quality asset, the best quality debt instrument that you could ever get. But this was not until early last week, where they got degraded by Moody. Moody Analytics is a credit rating agency, and there are 3 major credit rating agencies. There's Moody's, S&P's, and Fitch. They give out certain letter grades to different firms. So it ranges from AAA, which means best grade, investment grade quality, all the way to B's and C's, which means that they're considered high yield bonds. What it means is they're very risky bonds. So to make up for that risk, investors need higher yields, which is kind of what happened with U.S. debt. Because they were downgraded, their yields rose because investors require a much larger return on their investment. And there was a recent bond auction on the 19th and 20th, and because there was very low demand for U.S. Treasury, the yields had to go as high as 5%. And because yields went much higher, that brought some pressure to equities. Because it lowers the present value of equities. So the way equities are valued, by the way that equities are valued, when the risk-free rate of return, which is the Treasury yield, is high, the U.S. stocks need to perform even higher to make up for the extra risk that investors are taking on, and with higher yields, investors would prefer going with bonds because they would earn a lot more, because they would earn a considerable amount as compared if they went with equities, if we take the risk into account. And also there was a U.S. Treasury bill passed early this week, which will increase the U.S. deficit by 10%. It will add about $3.8 trillion to the U.S., which will make their deficit grow even larger. And part of why they were downgraded already was because they were not able to service their debt, because their interest rates are making up a large amount of their expenses, which is not good. And part of the downgrade was because there's uncertainty of whether they will be able to service their debt or not. And lastly, just to see some sectors in the industry, something that I found interesting was just how the U.S. economy is doing with relation to inflation, and with just with how different sectors react to how the economy is going. So we have Target and we have Walmart. They're both shopping. They're both they're both retailers, but they have different composition of goods that they sell. So Target sells more durable goods, which are said to be consumer discretionary, and Walmart sells consumer staples good, which is just your everyday items. And the inflation and the way that consumer discretionary goes is a very cyclical industry. So if the economy is doing good, then it means that those companies are going to be doing good. If the economy is doing bad, those companies are going to be doing relatively bad. So when we compare to how Target and Walmart have been doing, we can kind of see what customers' gauge of the economy has been. Yeah, we can kind of see that customers have been very optimistic about the outlook of the economy. And just to finish off, there have been some pretty good earnings releases. About 77% of the companies in the S&P 500 beat their earnings, and except for consumer discretionary, which signals that the economy might be going into recession. Every other major index had some pretty good earnings. And
Alright, so I'm Zoya, and I'm the portfolio director of Portfolio 2. And today me and Church are gonna talk about the fundamentals of finance, like the terms we usually use in finance, and so and pay close attention to this, because in the end I'll ask you questions and you'll miss out on chocolates if you don't.
Oh.
I got a bunch. Alright, stocks. They're like tiny pieces, they're like tiny slices of a pizza of a company. Imagine a company with a giant pizza, alright? And let's say that they want to make more money, and so that they can have more toppings on the pizza or open a new branch. And so what they think, instead of borrowing money, they decide to cut the pizza into thin slices and sell it to the public. Do you want a pizza?
Yeah, sure.
Now you have a pizza and you just bought a slice, and that slice is a stock. When you buy it, you own a small piece of the company. And if the company does well, the pizza becomes bigger and bigger. And if the company does shitty, the pizza becomes smaller and smaller. It loses value.
Maybe a bond?
Or whatever's next. Oh, the bonds. So the bonds. Imagine your friend Dave. He wants to borrow $100. He's always borrowing money. You lend it to him, and he gives you a note this time. And that note says that I'll pay you back in 5 years, but at 5% interest. And that note, that's basically a bond. In the real world, companies and government do the same thing, and they promise to pay you interest until they can pay you back the entire money. So you buy a government stock for $1,000, suppose, every year you get a little thank you note from the government as like $50 perhaps. So that's like a 5% yield. Alright.
But a lot more food based is on somebody who likes to eat. So a portfolio, what you guys are gonna be building, think of it as like your plate, all right? And how you cut up your plate is how your portfolio is organized. So like here they have a quarter of it in bonds, a little more than a quarter in commodities, and then you have stocks and cash or make up a good chunk on their own, right? So your portfolio that you're making is your dinner plate, and how you divvy it up into the different products, so bonds, as we were talking about there, and stocks and cash, is just how you portion out your plate of how much you like. So like me, I like meat, so I'd be a big stock person, so most of my plate would be stocks, but that's me. You might like bonds because they're a lot safer, so you got more veggies there, and you're probably healthier than me too, so that works out that way. Now thinking of your portfolio as a plate, an index is kind of like a fast food Big Mac, okay? I come home, I don't feel like cooking a meal, maybe the roommate's in the kitchen, I don't want to talk to him, it's been a long day. So I go to the S&P and I get an S&P Big Mac. And basically what that is, rather than me going through and figuring out all the different pieces and or making a steak from home, I'm gonna get a burger from S&P, and that burger is made up of other components, and it makes that one burger. So all the components, so like the lettuce, the cheese, the meat, those are all the companies in the S&P 500. And when I buy the burger, I get a portion, I don't get them all, but I get like small pieces of them already packaged. So that's kind of how you want to think of, well, that's how I think of indexes at least. Yeah, and then some famous indexes, you got the NASDAQ and you got the TSX. Just before, I feel like I'm talking really fast, any questions? Anybody hungry? Okay, good. You're hungry for knowledge. All right, and then this is my next one. So, sticking with food, you know. Your PE ratios is something that you're gonna use to figure out not how productive, but like how much value is in what you're purchasing, right? So if I went to you and I said, you got burger A and burger B, I need you to figure out which one is better value, but they're both $10. How do you figure that out, right? So one way, so a PE ratio, what you would do is you'd figure out how much protein is in the burger, then that gives you an idea of what that value of it, right? Because the 25 gram, but it's $10, that means there's, compared to the other one, there's 25 grams at least of something else that like could be sawdust, I don't know. But it's less valuable than the 50 gram protein one at least, right? So that's how you're gonna wanna think of your PE ratios and this is a basic formula, it's price per share divided by earnings per share. So the companies, based on their earnings, and then their prices per share, gives you an idea if you're getting that better valued burger than the other, and then like another stock. So you run it on both to see what their PE ratio would be, right? And then just kind of building on that, for a fundamental investing strategy, this is 100% ChatGPT. This is like the rule of thumb strategy, but basically, I kept it in kept it in food terms. So now you're tasked with going to figure out what companies to get, or like how do I determine the value of them, right? So like based on the rule of thumb strategy, fundamental, is you start to incorporate some of these things. So like you use the PE ratio, and that ratio gives you a value, and then you can base it off of that value. Now something that's really important is maybe 50 grams of protein versus 25 grams of protein isn't the end all be all way of figuring out the better value burger, but the PE ratio gets you in the ballpark, right? And this is where now with this grocery list, now you can start going through and seeing if that 50 gram one is better So then you start looking at like what their debt is, how much rate of return, or what their ROE is, yeah, return. Oh, that's not right. I don't know. Josh.
Equity.
There you go, thank you. Yeah, and then what their earnings are, dividend yield, and their current ratio. And we'll get into those furthermore if anyone is like head is spinning right now, but just so you know, right? You can use the PE ratio as a quick and dirty way of figuring out a value, how to like normalize the value of a stock versus another one. And then using fundamentals, so like this rule of thumb one, you can then incorporate that into figuring out if burger A is better than burger B in terms of value. Cool? Yeah.
Alright. Yields. AKA how much juice you're getting from your money. This is orange. Imagine you have like 2 oranges. And you squeeze the first orange, you get 2 ounces of orange juice. You squeeze the next orange and you would get only 1 ounce of orange juice. That juice is the yield. Yield is just a fancy way of saying how much money am I getting from this investment every year. Let's say you buy a bond for $1,000, it pays you $50 every year, and that's a 5% yield, like I said before. Now, if the bond price drops to a 900, and the government still pays you a 50 every year, that means your yield is 5.56%, and that's a really nice deal. So if stocks are parties, then bonds are a chill, nice tea party, and yields are basically free snacks you get, like just for showing up. Alright, so the technical strategies of investing, aka stock astrology with math. So you know how people try to predict the future, looking at the stars and stuff? Well, traders try to predict the stock market looking at charts. Technical strategies is basically about analyzing patterns and volumes and trends and watching the news. It's like trying to guess if the stock will go up or it will go down, based on its past behavior. Like, if you see your friend eating a hot dog 3 Fridays in a row, you know for sure, on the 4th Friday, he'll be at the hot dog stand. So let's say if the price of a stock keeps bouncing between 100 and a 120, at 100 is the floor, you buy up, and at 120 it's the ceiling, sellers go out. A technical trader waits like a ninja, and next time it drops to 100, he'll buy up, and when it goes to 120, he'll sell them off. So that's what a strategy is. That's just an example of a strategy. So now I have like a couple of questions. Who wants to answer that one?
What's the chocolate we get?
It's just like it has like
It's a
a couple of
surprise.
flavors.
Well, A is true in any circumstance. You can make whatever demands you want. You'll just get it.
But who will answer the one?
I want a chocolate. B.
Alright, go ahead.
B.
B?
I just said.
You own a tiny piece of a company?
Yeah.
Try hard.
Which one do you want? The pink one, the blue one, or the
Both.
both?
Oh, you got one.
You're getting greedy,
Okay, right.
You can have one more.
Basic says no. See, this is why you always make ridiculous claims.
Okay, that's fine. Do you think the stock has trust issues?
I
Go
know
ahead.
this one. It's C, definitely. Has to be. I believe
Diamond
that's
hands.
I'm not reading questions.
If I say B, can I get a chocolate still?
Yes.
Okay, B.
Yes. Yep. So the repeated bounce in the market is called support and haters. You can have both of them.
No, one.